Good afternoon, everybody. Welcome back from your break. Now we're moving into a very interesting panel discussion. I've got a very distinguished panel with me today. I'm not going to go through their biographies in detail. You're welcome to have a look at the notes that were circulated with the agenda. In brief, we've got Anne. Anne has got many years' experience in the retirement savings industry, in South Africa and elsewhere. What I really like about Anne is that she brings a forward-looking, let's fix this, let's make it better approach to the conversation. Welcome, Anne. And then we've got Claire. Claire's got many years of direct experience of pension funds in South Africa, and you can really trust Claire to make us think about what this means for the member. And that's really, really important, because at the end of the day, we're here for the members and what's good for them. So welcome, Claire. Then our international panelists, we've got David, who's from Mercer's. David is a senior actuary with many years' experience, and if you don't know about it, he produces with his colleagues a really insightful and in-depth report on the pension funds systems in many countries. What I really like about the report is it's not just a technical benchmark, but it's got practical and clear recommendations on how to improve the systems in each country. So welcome, David. And then lastly, we've got Tim from the UK at Schroders. Welcome. Tim seems to have really been or got to know the ins and outs of the UK industry, especially the changes with the master trusts, and so he's an expert, and it's very useful because our regulators tend to look at what's going on in the UK, and we certainly sometimes accuse them of a little bit of copy paste. So welcome, Tim. Right, turning to the topic, two papers released by Treasury. I'm sure you're all aware that these are not the first papers on the topic of reform of our retirement industry. These have been a very long time coming. I'm not completely sure when the start of retirement reform actually is, because we've had various commissions and papers, but these two really deal with very important topics. The first deals with preservation and access to savings, and the second deals with governance of umbrella funds. I thought to kick off the topic, I'd ask the panelists what they think Treasury has gotten right, and where Treasury is really, going in the right direction with the reforms suggested in these papers. Perhaps you'd like to start, Claire?
Thanks very much. Certainly, I think that this is a very progressive step for Treasury. I think both papers have significant merit. I think the two-part allocation is actually going to be a great incentive from a savings perspective if we can deliver in the education sector and explain to members the value. And I was really quite pleased to see that in terms of umbrella fund participation, that some of the challenges have been highlighted to the industry. So I found both really relevant.
I think one of the fundamental characteristics of a good pension system is indeed preservation. What's the purpose of a pension system? The purpose of a pension system, the objective, if you like, I think it's twofold. One is the public pension to alleviate poverty. But here we're talking about private pensions, private savings, so that people can maintain their living standards in retirement from their living standards in earlier years. And that should be the objective. So the concept of keeping the money, preserving it until your retirement years, I think is a big improvement from a typical South African experience. And I think the twin savings pot, the sidecar approach, if you like, or the multiple pots, the twin pot, we see that in South Africa, in Singapore rather, I think gives a little bit more flexibility, but people recognise that there is a need for savings now, but there's also a need for savings longer term for your retirement. So I think that development will encourage confidence and involvement, which I think is really important.
I think what I loved about the papers was not so much the concept that they represented, but the way they were written. There was a real sense that the people that wrote these papers had an understanding of how incredibly how really there's such inequality within these systems in terms of how people experience these systems. For example, when they discuss the tax impact to individuals, and you see that so much within the retirement systems in South Africa are much more at the disadvantage of the lowest income and much more to the advantage of the highest income, which is one of the real problems that we have. So the fact that they pick that up and they highlight where we've got some real issues in terms of tax arbitrage and what have you in these systems, I like that. I like that sort of insight. But I'll have lots of other comments later.
Can I just pick up on something you said, David? Some people have commented and said, well, if you go to this two-bot system, this the one that has a level of access, that's just going to be it's just going to be drawn down as fast as possible, and many people, you can just write off 1/3 because it's all going to bleed out. Has that been the experience elsewhere, and what would you say to them?
Well, I think that you're right. There is a danger of that, but the experience in Singapore, which have 3 or 4 pots of money, is that savings pot is actually often still there at retirement. Now they do have a pot of money for housing and education and medicine, but often people don't access that money because they like it for a rainy day. If they're ongoing, they're saying, okay, I've still got a job, I've still got income, I'm going to leave that money. And in fact, sometimes that money is left until retirement. So it actually boosts their retirement savings. Having said that, I think that smaller pot for savings is not a pot that should be available for every expenditure on a day-to-day basis. It should be available perhaps once a year, maybe the minimum drawdown figure. So it's for the unexpected expenditure. It's for the car breakdown. It's for the medical emergency, if you like. It's not there for regular expenditure. So you put some constraints around it so people don't see it as a day-to-day living expense. It's for that unexpected event, which we all have, and that is part of life. So I think in that sense, it does give people confidence that there will be money, not in the retirement pot, but in the savings pot if I need it.
Excellent. Tim, there was quite a focus in the papers on value for money and on some of the governance approaches that have been adopted in the UK. Do you think that there's any aspects where Treasury is going, in the right direction, and you would encourage them to press ahead?
I think looking at our experience in the UK when we moved to auto-enrolment, which was in 2012, there was a number of aspects that people were very keen that needed to be put into place. Before, we'd had a purely sort of commercially driven system. And when they moved to auto-enrolment, they felt that they needed to put some more protections in place. So a couple of things really changed the dynamic of the market. First was this idea that we needed to have aggregated pension vehicles, typically through a master trust arrangement, where there was still trustees had a fiduciary responsibility over the assets. Previously, aggregation had really happened at the insurance company level through what we call group personal pension, where you didn't have that same level of fiduciary oversight. And second, to ensure what this new term called value for money that was started to be discussed about, is a maximum fee that the member would be paying was put into place. That was set at 75 basis points. That in itself added a level of protection and comfort, I think, to ensure people did put money into this and didn't opt out. So it was auto-enrolled rather than compulsory. The consequence of that, however, and the market dynamics we've seen within obviously the commercial angle of this is that people could see an awful lot of money was going to come into the system. That has led to a very much a focus on the actual costs and lowest cost equaling value for money. And there was no definition, and still isn't today, of what value for money really means. There's lots of sort of implications of what that means and what trustees have to look at, and they have to go through an annual process called chair's statement and lists and do value for money assessments. But because of the commercial realities and because of what people deemed value for money to be, we've got to a position where lowest cost is seen to be the best outcome for individual members rather than the total value that that's delivering for them. So that is a problem. I think having a focus on value for money is right. It protects individuals and it gives trustees a focus, but trying to define what that should be purely in investment or purely in sort of pounds and pence is a difficult thing to do, because naturally people can say, well, this is cheaper than that, so therefore it should be better. And that's not always the case.
But surely all else being equal, lowest cost is better. And I mean, what are the unintended consequences? Wouldn't we prefer not to be, wasting members' savings in high fees and charges?
Yeah. So if you hear that all else being equal, and there's been various reports written by investment consultants and others about this all else being equal, and it was picked up by numerous government departments. I guess the challenge is, what's the baseline? If you want to set that everyone with exactly the same investment strategy have exactly the same member engagement tools, whether that be digital, paper-based, etc., then yes, all else being equal, you'd be better paying a less amount than more. But the whole dynamic of the market under a commercial and competitive market is to try for providers to say, actually, I think my investment strategy is better, and therefore I can justify a few extra basis points, or the fact you get a digital interface, particularly now through apps, etc. They tend to be more expensive than the lowest cost. So that's where we've got to. This concept of all else being equal isn't, everything is not exactly the same, but we're getting to a very homogenized point where all else is becoming equal because of the pricing pressures that actually all investment strategies now are looking very similar, and everyone wants to have exactly the same, and differentiation in the market is disappearing. Some of that is intended, I think, because we're trying to move to some very large pots. The regulator does not want small pension schemes. That's very obvious from a number of angles that they're bringing in.
If you talked to me 5 years ago, I would have said absolutely, lowest cost, forget everything else. But we're slowly realizing that our members are asking more about what are we doing with their money? How is that money working for them? And I think you're seeing an absolute tipping point here in terms of a consciousness that money can do much more than just make money for yourself. It can actually, if done properly, can have an incredible role in terms of systems change and addressing other issues in society. And that's what our members in South Africa are looking for. Now, if you tell them or encourage this sort of lower cost strategy, you're going to absolutely eliminate any kind of opportunity to do any kind of transformative activities with your assets, because it'll just simply be too costly to do that. So on the one hand, what Treasury has done is that they've said over here, you have to focus on transformation, climate change, sustainability, and that. And then on the other hand, they're looking at the cold cost issue. And these are two competing agendas. And what I'm fearful for is that we're going to cut this one, the transformation one, right at the kneecaps, because you won't be able to do it at the lowest cost. And you'll have a situation where people are only going to be, markets just become like solid commodities. There's no value in a particular market other than its risk premium, let's say, for the particular asset class.
Yeah, David?
Yes, I build on what Anne said. I think a fixed cost is going to drive you down to that basic provision. You're not actually thinking more broadly about the member outcomes, what the member's going to get. Tim mentioned the apps, if you like, the communication, the web-based calculators. What people are going to need help, they need assistance. You're not going to get a lot of that. You're also not going to get innovation in products. Developing a new product, whether it's a retirement product or an investment product, takes time, it takes money. And if you're down at that lowest cost, you're not going to get that. And I think you'll also find that you won't get the diversity of investments. And what I mean by that is not only in different asset classes, but indeed around the world. If you're going to invest in overseas equities, overseas property, which may be a very good investment, that will cost a little bit more. It may give you a good return. So there is a danger that you come down to the basic commodity, that everyone looks the same. There's no differentiation. There's limited innovation. Yes, you've cut fees, but are members getting as good an outcome as they could? Now, don't hear me saying I want hive, but I want competition. I want enough flexibility in the system to enable people to offer different products, different services. If I want to buy a Volkswagen or a Mini Minor or whatever it was, I can. If I want to spend money and get the Rolls-Royce version, where I get financial advice and other add-ons, I should be able to do that too.
So I'm hearing, that we're saying the danger of focusing too much on value for money is that it becomes a focus on cost above all else. But surely we do actually need to focus on value for money in South Africa. I mean, we all know that at the other end of the scale, there are members who, it doesn't look like they're getting value for money in their current arrangement. Claire, what would your perspective on that be?
So you're absolutely right. You have to measure cost against value. So for me, it's all about appropriate, well-priced default opportunities, and then allowing members the opt-out opportunity so that they can decide based on their own profile and what their appetite is for cost, benefit, and service. So certainly we've seen some great strides within the industry across the investment platforms in terms of very innovative stuff that's coming to the market that members absolutely have an appetite for. So I think cost is really relevant, but it's also understanding what that cost is. I found for far too long, certainly from an investment perspective to a high degree, there's been a degree of mystery around how costs are calculated, both in terms of the portfolios as well as how many of the administrators represent that cost. So for me, you absolutely need to balance cost and value, definitely, but also you need to be entirely transparent in how you're reflecting costs so members can make a proper informed decision.
Well, let's take the issue of administration costs. We know that in certain situations, how you charge a low-income employee versus how you charge someone who has a lot of assets under management will have a differential impact on them. And you cannot have one model of charging that is suitable for all the participants. And that's, you're really going to battle with this apples for apples sort of administration charges dynamic. And that's what we're going to be go ahead, David.
In the UK, we've seen a number of different models appear, sort of fixed cost charging on for smaller pots, and then basis points ad valorem charging as you go up. Those models haven't really caught on as much, although they're permitted under the charge cap. So I think trustees, or actually it's normally the corporate who's the buyer of a master trust, slightly struggles to understand how those costs actually work, where they're more comfortable with a basis point cost. But you're right, then that means there's a level of cross subsidy going on in the pension scheme that people perhaps don't understand in the same way. Just going back to transparency of costs, we've seen an awful lot of regulation come down the line in the UK around transparency of costs. All well intended, but there has been some consequences of that. So there's a lot of transaction cost analysis. Now, it's not included in the charge cap, so you don't have to sort of make an allowance for that, although there's been numerous people who have made the case that it should be included in the charge cap. But you've added a layer of complexity. So yes, there's disclosure of those additional costs, but again, do people understand what they really mean, or are they ticking the box for a trustee to try to say whether this transaction cost for trading is more effective than this one? But at least there has been a recognition that there is a whole layer, there's a number of layers of cost that need to be disclosed. So we've got that, but it is, again, it's very onerous for fiduciaries to go through that process.
probably one of the layers of costs that they'll never see, and that's one of the reasons why the discussion around the umbrella fund governance is so heated, is because you're not going to see the margin that a particular company makes on a particular asset manager versus another asset manager. That won't be disclosed. You'll only see the cost. But there are plenty of asset managers out, or umbrella funds out there that'll push one solution over another solution because they make much higher margins, and it really doesn't make that much difference, is sort of the thinking that goes on, because maybe they're all balanced funds or something like that. But that'll definitely be an outcome that will never get disclosed.
Before we move on to other questions of governance, isn't there a danger that we reinvent the wheel here? I mean, surely there is some country, some pension system that's done a good job of transparency, of communicating charges and an appropriate focus on value for money, or is everyone struggling with this, David?
I think if I go back a step, traditionally many of the well-developed pension markets have defined benefit pension plans. And in a lot of those defined benefit pension plans, you had employer or corporate sponsors who were actually picking up the costs or subsidising the arrangement. We're now moving around the world to defined contribution arrangements, individual pension pots, if you like. I might change jobs, I stay in the same umbrella fund or master trust. It's not linked necessarily to my employer. So costs are becoming important. And I think we are seeing in the UK, in Australia, elsewhere, greater communication about costs. But communicating that cost is tricky because there are various elements of the cost, and most people don't understand. I mean, even those within the industry have difficulties adding administration costs to direct investment costs, indirect investment costs, broader costs. So yes, there is a fee. We are seeing in Australia I won't get into the details, but a performance test by the regulator that says what is the fee paid by a member with an account of $50,000. In other words, is your fee above or below the median? And that is published in the default product. As Claire has said, I'm a big believer in default products and flexibility beyond those who want to choose. I think where fees are important is in the default products, because the auto enrolment or the compulsory system puts you there. And let's face it, 20 or 30-year-olds don't care about pensions. They've got other things in their life that's a lot more interesting than their retirement pension. So we need to protect those individuals from paying excessive fees. But as people get older, as they understand a little bit more, they need flexibility, they need choice. So I think you've got this balance between default and choice. It is an evolving thing worldwide. We've heard in the UK the caps, in Australia the publicity of the fees. Certainly one of the things that we're looking at in the index is it a requirement to publish the fees an individual paid each year? To my mind, that's an absolute requirement. You should be told what fee you've paid in the last 12 months. In some countries, that doesn't even happen.
Just quickly on the UK experience, is the cap itself actually, if you look at master trust particularly, I mean, there's very few master trusts that actually charge anywhere near the cap that was set. So the commercial realities of trying to compete in the market has actually driven down the cost, because particularly for large insurers and new players, they can see the assets that are going to grow, which will be substantial over time, because of, although we're auto enrollment, the take up is extremely high. So it's not that the cap itself is too low and there's not enough flexibility in that. There's plenty of flexibility where the cap's been set, but the commercial reality of competing in the market has driven particularly the large insurers to move right down that fee scale. And that's where we've got this sort of problem, and trustees have then said, well, that's fine, because actually that's a good show of value for money, that this is a really competitive market, we've moved down. So you've got two dynamics, but the cap itself isn't set at the wrong level. There's more than enough space to do really interesting things in investment strategy. And if you look at some of the large single trusts that still exist, so big banks, etc., who haven't moved to master trust, they've got great governance and they're doing really interesting things in their investment strategy using private assets to focus on climate change and things like this. It's more at the very commercial end of the master trust market where we've seen fees come right down, and that's to do with commercial pressure, if more than probably anything else.
I want to move on to some of the other governance aspects. I mean, we had a whole paper focusing on the governance of umbrella fund arrangements in South Africa. I think, Claire, you opened by pointing out that there are real issues and there are real governance challenges in South Africa that need to be addressed. Do you think that these steps are going to tackle the right issues and are going to sort things out? And are we missing some opportunities and some things we should be tackling?
So I think it's a great opening conversation. I certainly don't think that this paper is sufficient to deal with the significant structural aspects that are problematic within those umbrella events, but I certainly think it's a great opening conversation, and any board of trustees, any manco within an umbrella fund effectively should now be asking their providers for details around the gatekeeping process to the umbrella funds, what service providers have been allowed access to those funds. And speaking to Anne's earlier point, she's exactly right. It's shrouded in such a high degree of mystery that you really need to unpack the fund's financial statements, and that only gives you about, I'd say, 70% of the story. I think the balance is all in the pricing before you apply units back to member records. So I think it's a great starting conversation. I certainly don't think that it's gone far enough to address some of the significant structural issues, but hopefully now within the umbrella fund participation, all the participating employers can start to have those conversations with their providers to ask for a far more detailed unpack of what is and isn't allowed within the structures to which they participate.
The whole concentration of the industry, the kind of reduction of funds, I understand exactly why the regulator wants to do this. My concern is that we're going inexorably towards a DC model. I mean, there's no turning back here the way we're going. And, I know this is a conversation David has. I mean, if you look at his whole pension systems index, it sort of presumes that somewhere in there is some sort of DB model or some sort of underpinning guarantee so that poor investor doesn't assume all the risk of. And we don't have that here, except for old age grants, old persons grants, excuse me. That's really the situation that I'm sort of concerned about. Plus, a conversation that we had earlier, David, that I wanted to tap into before with you is, we're assuming that the best model is a commercial model, a for-profit model. And I asked the question, why can't we just convert these all into mutual funds? And so that everybody, all the decisions are for the mutual benefit. And you said that there was a kind of in Australia, you had two systems. And I don't know whether or not the commercial one still exists because it existed there first, or what the situation is and why there's a distinction. So I'm asking David a question.
Well, yeah, that's okay. Thank you, Anne. In Australia, we are seeing a decrease in the number of funds, as we've talked about here and elsewhere. Predominantly in Australia, we do have two broad systems. We have retail master trusts, and we have not-for-profit mutuals, which we call industry funds because they've grown up in particular industries, construction and building, for instance, retail. So there's no for-profit motive in there at all. They are, if you like, profit for members. But having said that, they outsource their administration to an outsourced provider who is a for-profit operator. They would outsource some of their investments to a for-profit fund manager. So when you boil it down, there's not that much the difference is not as big as it may appear. But clearly there are the two models, for-profit, master trust, umbrella funds. Just the Mercer one as an example, 240 different employers. We've been running that for 20 years plus. But what you do see in the defined contribution arrangement, and I agree with Anne that that's the way the world's going, is the role of employers is decreasing. The role of individuals and individual responsibility is increasing. So we're going to see a role of individuals. We're going to see a greater need for government defaults to protect those individuals. And then to pick up Anne's comment, well, how does that then deliver pension in your retirement? Because that's ideally what we want to deliver. And therefore you need some very careful thinking in the accumulation stage. What does the product look like when I retire? Do I just get a pot of pension money, rands, dollars, whatever, and I go and spend it on a Lamborghini, which is the fear that we saw in the UK when you had the pension freedom changes a few years ago. Our history in Australia is in fact that retirees are too conservative. They are hanging on to their money in case they reach 100. Because of course none of us knows whether we're going to reach 70, 80 or 100. So it's actually the reverse. So we do need better products. Around the world, I don't think anyone's solved this perfectly in the DC world, but that's a slight sidetrack. But
I have this is my other big, and David knows this very well, that this is my other big issue. If you look at the Australian situation, one of the more interesting aspects of it is that people have been borrowing during the journey that they've gone to retirement against that pension fund to fund their housing. Okay, so you end up at the end where, and my comment is this: we treat pension funds in a very siloed element as though that's the only thing that's important in terms of social protections for individuals. Well, in South Africa, that can't be the only thing that's important. It has to be a whole range of things. It has to be education, it has to be health, it has to be, taking care of your children and your grandparents in one household. It has to be a whole bunch of things. And so the other trajectory that we're moving on, which really disappoints me terribly, is that what we really should have is really umbrella employee benefit funds, where you have a range of different options that you can look at that you can get at a low cost, significantly lower than you could go out and get commercially as an individual. Access to things that provide a holistic care for you and your family. And that's what the employer needs to be offering, with the pension fund just being one small component of it. But we've put the pension fund up on a pedestal as though it's the only thing that's really important in people's lives, and it just isn't. And that's why we're not getting the kind of recognition that I should have a pension fund, because nobody's helping me solve the other part of my life's problems. And if we did that holistically, and the comment I made earlier when we were talking was, this is where the fintech guys could really jump in here, if they had big, entities behind them, but they don't. They're just sort of operating at the fringes right now. But until we get this holistic solution out there, the fact that we passed on all this risk to the individual is really a recipe for, continued inequality and underperformance.
If I could just make a comment there, if you wouldn't mind. So Anne, you're absolutely right. The housing guarantor provision within most of the retirement funds now is not very well used. It's not terribly well understood. I don't think there's sufficient of a base rate against prime discounts in terms of those interest rates on really well protected loans. And there's very little management and control that people actually use that money for the intended purposes. So that can certainly be improved on from a housing perspective, where you're expecting somebody to retire successfully because they've worked a long time for an employer, but they're living in an environment where they have no running water and no electricity. I mean, that's the real issue within our environment. In terms of the proposals for the new separation of your asset system in terms of potential aspect or access, I think David's exactly right. There needs to be some guidelines in terms of that control of what that money is necessarily used for. So it's not the daily grind. It's things that really add value back to people's existence. The challenge again within the South African market is how do you monitor, control and regulate that, and how much should you regulate people's own access to their money? So it creates quite an interesting contradiction. I found in the last 6 months, every single member presentation I've done, people have asked on the back of what came out in the press middle of last year, I believe I can access some of my money. How do I do that and when can I start? And literally that comes up at every single member session. And on the back of what came out the budget speech, if we were to start the system in the short term, I think many of your fund administrators are going to absolutely crumble under the initial volume, like we saw initially when housing loans were issued. We had that massive surge, and now it's very diluted in terms of how people access that.
So can I just...
That's why you can't offer it. Okay, I mean, I was just going to say you can't offer it without the guided hand, you know, the hand that takes you through the process. You can't just sort of, here, it's open season, guys, go for the money.
So,
but offer without a perverse incentive of the people using the guided hand to be necessarily over-enriched at that process. So that's the rub, right?
Yeah, I'm struck with the practical implications of what you're suggesting. I mean, how practically in pension funds in South Africa can administrators or boards of trustees get involved in actually saying who can and can't have access to their money? If you put any kind of restriction in place, you've got to prove hardship or whatever it might be.
Yeah.
Is that even feasible?
No, you're not going down that route. You're going down the route that the minute that employee signs up for that employee benefit package, which is one of which is a retirement fund, you're starting to engage with that employee. Now you can do this with fintech, and you can do this on a cell phone, and you can do it quite nicely now, where you start having questions with that employee. What other problems do you and your family need to solve for? What are your basic needs? And anytime they start hitting crisis points, you have somebody who can advise that person on what their options are besides immediately tackling their pension fund or immediately tackling their emergency savings pot. So it's a continuous engagement that you're having with that individual as they go through life. And as they hit those rough spots, they have someone they can turn to. Now, the problem of doing that, of course, is that if you do that within an employer basis and the person switches employers, what then happens? Which is why the superannuation fund is sort of an interesting kind of a model where there's just one fund and, you elect to be in there. But that's part of that service offering of that fund, that it can help you with those trade-off decisions that you have to make in life. And that's the challenge that people with very small, they face a trade-off problem, not let's make sure I just keep money in here. I'm going to have to take it from someplace. Where do I take it from where it'll not do the most damage to me in the long term?
I mean, that sounds wonderful. I'm still struck by, the cost implication of that kind of a service and the levels that, as David said, no 30-year-old really is, cares about what's in their pension fund until they hit the wall. So, is that doable? Is it really doable?
I think it comes back to the objectives. What are we trying to do? What's the goal of the operation, if you like? And as you move towards the goal, you don't get there in one step. You've got to do it gradually. Anne mentioned technology administration. You've got to take people with you. You start off small, and you might start off with a pension emergency savings account. Then you might add another account, whether it's a health account or some other form, or highlight what you can use the emergency savings account for. You don't do it all in one gigantic transformation step, because you'll lose lose people. They won't understand it. They'll fear it. You've got to do it step by step. And that enables you to bring the technology with you, gradually upgrade, update, change the admin system. What's the end goal in 2050, if you like? What would it look like when we've done all this?
So it strikes me that to implement changes along that way, you have to be very deliberate and you have to be working to a plan where you're introducing changes, well thought out and into the system step by step, and the transition becomes very, very important. To get that right, you also need good communication to the industry around what's coming, because the experience is, okay, we've now got to cope with this, and it's a new systems project and a reconfiguration, and you don't know what the next step's going to be, so you don't design with that in mind, and then the next step comes and people are caught flat-footed. Has there been any examples of sort of pension systems where you could say, a really good partnership has been in place with good signposting of what's coming, and then a rollout over potentially decades of changes that has moved the system in the right way, where the industry, being the administrators, the funds, the trustees, etc., know what's coming and can build accordingly? I mean, are there any good stories that you can point to?
Well, Tim can speak better than I can on the UK experience, but one goes back to the mid-noughties, if you like, 2005, the review, 2008. Order was introduced. Tim was saying that started in 2012. The low contribution rate for employers then became to medium, smaller employers. The contribution rate got ratcheted up gradually. There was a pattern, and now they've got a position where most workers have got a pension plan. That was not the case 10, 15 years ago. Everybody's got a contribution rate of at least 8%. That was not there. Yes, you've got I'll call it government supported, Tim will correct me, nest. There was sort of a government operation that helped that with the smaller. But there was an example of a decade that the UK took from where it was to where it is now, and it's continuing to develop. And that's an example that I think worked well.
But that is still focusing on the pension fund. And so, go ahead, Tim.
That's true.
Yeah, I mean, it was. I mean, very much so. It is a pension provision, and I think the process did work. There was lots of scepticism. The rationale behind it, I think people were sceptical because obviously it was to the death knell in the DB system and the commercial DB system, the corporate DB system. But I think if you take that in isolation, it looks great. But if you look at all of the regulation we had up to that point, and now the regulation we're getting, which is very piecemeal. So, if you look at why DB eventually just ended, is because you kept having regulation on changes on amounts that had to be paid. It was so piecemeal, and it just layered and layered and layered, so it became totally unaffordable. We've seen DEC, so the actual auto enrolment framework and the journey that was set out has actually been pretty much stuck to, which is quite amazing and did work. But in terms of the layers of regulation that we've seen, in terms of governance regulation, changes to all sorts of things that have been done in piecemeal, that's had the problem. So you're right. For these things to work, you need a long-term plan, and you need to be able to deliver on that and try and remove it from being as political piece, because that's the other thing is, you change sort of governments every 3, 4, 5 years, then you might get different regulation. We've had an awful lot of pensions ministers within the UK, and they have different ideas. So the actual auto-enrolment framework was well set out and stuck to, but we've seen sort of a creeping back of this very short-term thinking in terms of changes of regulation affecting governance particularly, and requirements on trustees. So
design the system and roll it out slowly over time with no political interference. Not a small ask then. Something.
Can I make a point?
Please do.
I make a point in here, because I think we actually have made the first step in the right direction if we pitch it right. And obviously Tim's right. If you don't have political will, you don't have anything in here. But we've introduced this sidecar, this emergency savings. And if we pitch it in the right way, and we tell the industry, first step towards having an interaction with your client, at an individual level, not at the pension fund level, but at the individual level. How's their particular well-being, and can we start talking to you right from day one? And then we can start adding on other features, as David says. We can start adding other things so that we get to something that you asked whether there are systems out there. David knows that I think the way the Singapore model started, we could criticize it now, but the way it started was brilliant, that it sort of didn't make the presumption that you were saving for retirement. It asked the question, what do you need right now to get yourself out of the dwang, as it were? And it was housing at that particular point, and they could do something about it. And so then they evolved the model out that way, where they could add education, they could add multiple, and now everybody in Singapore worries about whether or not they've got the highest performing asset manager, because they've already solved, their housing problems and other things like that. So if we roll it out here in South Africa, that this first opportunity here with the two-pot system is the first opportunity to have a conversation about trade-offs and wealth creation, then we can maybe build something up. But that means it's an umbrella employee benefit fund, not an umbrella fund that just solves for retirement. And that's a whole regulatory problem, because right now, as David rightly points out, the employers just stepped away from this conversation. We don't really care. And yet, if you asked a room of people, like I did the other day, of employers, what's the most important benefit they can give their employees, the last thing they mention is a retirement fund. The retirement fund absolutely does nothing for an employer, nor does it really, I said, well, who does it help? And it helps government. That's what a pension fund helps. It helps government having to, not be the welfare agent later on. So how do we not get to that point where we have to have a welfare agent? How do we get a trajectory where you can have sustainable wealth creation? That's the challenge for South Africa.
And there are ways of doing this. If you set up, I'll call it a pension pot, but picking up Anne's concept of a multi-benefit pot. It's not just pensions. So you have a contribution that goes in for health. There's maybe a contribution that goes in for housing, or so you broaden the base. You start off small, but you broaden it over time, so it's a bigger umbrella than just pensions. And then when you come to retirement, you also recognise that if someone has owned their own home and they've paid off the mortgage, then they've got an asset that can be turned into retirement income. It's not just an asset that's an inheritance. They may want to do that, but you've also got the opportunity of converting that asset into a pension. So
I think the key to making that work was that, you were still solving for the absolute minimum. If you didn't, if you lost everything, it would be sort of the equivalent of you'd still get the old person's grant, no matter what. So you'd still have that embedded in the system somehow.
I come back to one of the purposes of this whole system, have poverty alleviation there as an undergirding basement. And then on top of that, you think about living standards.
I think we could spend a lot of time on this and what a utopian system would look like. But I am aware that
it exists.
I'm aware that we've used up almost all of our time. What I'd like to close with is to ask each one of you, if you were able to give Treasury one piece of advice in this whole realm, and you can touch on anything from either of the two papers or in fact from experience in other countries in this whole realm of retirement reform, what would your one piece of advice be? And I'm going to start with you, David.
I think my piece of advice was to bring the community with you. Do it gradually, explain what you're doing, highlight the benefit of what you're doing, and do it gradually. You don't want this big change. Engage people. It's not just government from on high saying, do this, do that. We are doing this. There's a social compact component to it. We are doing it for the benefit of everybody, but we're doing it gradually. Engage the community.
Excellent. Tim?
Going back to the value for money piece that we talked about at the start, and trying to have a concept of what that really means, and I think showing the different charging structures for the different components so people can understand where their money is going and which bit maybe they think they should get value from. We have a all-in-one fee approach, and you don't know whether that's for administration, for investments, for whatever it be. So I think trying to define value for money in a better way than just a broad concept.
Claire?
I'd certainly say both papers have value, and well done to the drafting environment. I think that this is a really, really good step. For me, it's got to be about transparency of cost as a foremost, and then making sure whatever is finally promulgated can actually be applied within the industry. So often we have legislation that's first ruled in thinking, but the implementation lags significantly and leaves the industry with more questions than it has answers. So just make sure that whatever you finally decide on can actually be applied at industry level.
Anne? You get the last word.
I think both you, Richard, and David make important points. David's argument is to bring the people along with you and find out what their needs are. But Richard, you make a really important point. And we have to remember that right now our system, our retirement system, is dominated by the private sector. And the point you make is that unless you give the industry a game plan of where you want to take this evolution to, they can't prepare. So you throw out something. If you look at that two-pot system, I remember David McCarthy was trying to introduce that 10 years ago. And we couldn't do it because the administration and of companies just couldn't handle the thing. But if people know where we're going, and they know that what we're trying to do is bring the employee benefits back together with the benefit, the pension fund, bring a holistic view back, and get everybody sort of thinking, how do you do that? And get competition and fintech and all that stuff going. Then I think working together with the public and private sector, we've got something very powerful. But as long as we don't know, as the private sector, what the direction is of the government, we're just going to hunker down and just keep kind of plugging along, doing exactly what we need to do without incurring additional costs.